Are big Wall Street investors driving up housing prices in the US and preventing home buyers and small-time investors from getting into the housing market? Well, there has certainly been a ton of media coverage suggesting that recently, but as is usually the case, the answer is not so cut and dry. Today, we are going to dig into the real data and information and uncover what Wall Street's role is in today's red-hot housing market, and we'll also talk about what I think is far more important, which is the risks Wall Street poses to both home buyers and small-time investors in the long term, because really that is what worries me more than what is actually happening today. What's up, everyone? I'm Dave Meyer, real estate investor and vice president of data and analytics at BiggerPockets, and I'm excited to get into this week's topic because there's just a lot to discuss here. But before I do, please make sure to throw us a thumbs up. It really does help us out. All right, let's do this thing. Wall Street, housing market, what is going on here? Over the last several months, there has been a lot of hype about Wall Street driving up the housing market. I've seen a few dozen headlines about how no one can buy houses because these large institutional investors are buying up all the houses. But being somewhat skeptical, I wanted to see if this is really true. So to do this, I looked at some data first from Redfin, which shows that the share of homes that are purchased by investors is currently at 15.9%. For context, this is still a bit below where we were pre-pandemic when investors were buying a bit more at 16.1% of all homes of the US. Now, measuring the share of investors and how much homes they buy is actually really pretty tough. So to counteract that, I looked through a few different sources. I looked at Redfin, John Burns Real Estate Consulting, and CoreLogic, which all three of them are really respected firms in the real estate industry. And while they all have these different methodologies for figuring this out, they all show similar patterns. And those patterns are investor home buying has not reached new heights since the pandemic started. And some reports, like John Burns, show that investor home buying is actually peaked in 2013 and is lower. So to me, this provides a strong indication that investor activity is not leading the surge in home prices. Nothing has really changed with respect to what percentage of homes are being purchased by investors. By all accounts, investor activity is either lower than or at worst equal to investor activity over the last decade. And keep that in mind, that this data that I am citing refers to all types of investors. So both large institutional investors and small-time investors and mom and pop landlords as well. If we want to drill down even further into just large institutional or Wall Street investors, recent data is pretty hard to come by. But I did track down some 2018 CoreLogic survey that estimated only about 1 to 2% of all single-family purchases were made by large investors, whereas about 18% were made by small investors. That is another point that suggests that as of right now, as of today, Wall Street's activity is not fueling the crazy housing market. Instead, the housing market is being fueled by the fundamentals that we've talked about a lot on the show over the course of the summer, but let's just recap what those are quickly. First, we have extremely low inventory. Second, we have growing demand from a huge generation of millennials who are starting to hit the peak home buying age. And third, of course, we have extremely low interest rates. This makes for the perfect storm of housing prices going up. To me, the current housing market is more a function of these three factors than it is the activity of institutional investors. But, and there is a big but here, I do think that might be about to change. These huge institutional investors are not dominating the housing market yet, but they have some serious advantages over regular home buyers or small-time investors like myself, and that has me concerned for what might be coming in the next few years. And this is really what I want to dig into this week because it's something that we all need to pay attention to. As we get into this important topic, I want to first define what I mean by Wall Street or institutional investors. The biggest of all these companies is a company called Invitation Homes, which to no one's surprise is an offshoot of BlackRock, the world's largest asset management company. And Invitation Homes owns approximately 82,000 single-family residents in the US, which is undoubtedly massive. In fact, it is so big that they are approximately 58% larger than their nearest competitors, a company called American Homes for Rent. But to keep these things in perspective, there are an estimated 15 million single-family rentals in the US, and Invitation only owns 0.5% of them. They are an estimated 80 million single-family rentals in the US, and Invitation Homes owns just 0.1% of that. So again, companies like this are big. They are very big, but they are not controlling the housing market right now. But what scares me and worries me are the massive advantages that companies like Invitation Homes have over individual investors and regular home buyers, because these advantages means they can outcompete almost everyone and therefore will probably only increase their acquisition levels. Let's talk about these advantages. First is financing. Right now, interest rates are super low for regular people, and that's really awesome. If you or I were to go out and look for a mortgage, we could probably get a rate on a 30-year fixed rate mortgage somewhere around 3 or maybe 3.5%. And that is close to the lowest it has ever been. But on the other hand, Invitation Homes can borrow money at something like 1.5%. And that may not sound like a lot, but it means that they can bid $10,000, $20,000, or even $30,000 more on a house and still pay the same on their loan that you and I would pay for a less expensive house. So institutional investors can offer more on a house and pay the same. That is a huge advantage. The second advantage is cash offers. I mean, have you heard of anyone losing out to cash offers recently? Because I know I have. Well, not all of those are from institutional investors, of course, but you can be sure that institutional investors can and will make cash offers and either hold those properties in cash or refinance them later. And of course, this gives them another huge advantage in winning good deals. They could close in a matter of days when normal people who have a mortgage have to wait weeks or even months. The third advantage is data and research. And listen, we at BiggerPockets are working hard to bring our members, who are almost all relatively small investors, as much data and research as we can. And we have some really great info for you at BiggerPockets.com, so make sure to go check that out for free. But these companies have teams of data scientists building algorithms to predict which properties and markets will yield the best returns. Not many regular people have something like that. The fourth advantage is simply patience. These companies don't need somewhere to live. They just want to chase the best returns, and they can wait as long as they want to find a good deal. Regular home buyers often don't have that luxury. The fifth advantage is efficiency of scale. I told you earlier that Invitation Homes has 82,000 units. They absolutely have multiple teams of maintenance people, leasing agents, property managers, and anything you can think of. They use their purchasing power to source materials for cheaper. They can rehab properties for cheaper, and they do. In general, the larger your company gets, the more efficient you get, and that is definitely true of these companies. The sixth, and perhaps the most concerning of all these advantage is the market share in individual markets. Now, I said earlier that these companies aren't controlling the housing market on a national scale, but on a local scale, they absolutely could. There was even a report that Invitation Homes actually bought 90% of the inventory in a single zip code in the early 2010s. Again, that won't move the whole housing market, but think about what that does. This essentially gives Invitation Homes a monopoly on housing in this single market. They can outbid normal homeowners who just want to find a primary residence. And then when those homeowners who can't afford a primary residence turn to renting, they are facing the prospect of renting from a massive corporation who owns pretty much all the rentals in your area, giving them pricing power over rent. This has the potential to truly spiral out of control in my mind. We already have this affordability problem in American real estate where normal Americans and individual investors cannot afford to get into the market. If big institutional investors start targeting a specific market, that could really get out of control. They could start dictating prices in both the housing and the rental markets in any area where they get sufficient market share. And let's be clear, this is their stated business model. They are concentrating on specific markets like Charlotte, Atlanta, Phoenix, and Las Vegas. And prices in those markets have been skyrocketing along with everything else. But if this continues, we should expect those markets to see massive increases in both rent prices and housing prices in the years to come. And their tactics, they seem to be working. All these advantages are leading to very strong performance. Invitation Homes has a portfolio of about $16 billion and collects rents of about $1.9 billion, which is almost exactly 1% rent to price ratio. So their portfolio as a whole is meeting the 1% rule. And as I've talked about in previous videos, the 1% rule for you and me is increasingly difficult to find. And I also want to stress that these types of homes that these companies buy tend to be the type of homes that individual investors like to target as well. They're mid-price range, they're fixer-uppers that make good rentals. So they are competing directly against small investors more than they are actually competing against homeowners. Because these companies can bid more, they can bid cash, and they can renovate at lower costs, it gives them a structural advantage over small individual investors. And I've been talking a lot about this one company, Invitation Homes, in this video, and although they're by far the biggest one, they are just one example. There are dozens of other companies out there like this. What should you do about this? Should you just throw in the towel and buy stock in these giant companies? No, of course not. Don't do that. Well, you could, but you should also still continuing on your path. So what to do about it? Should you just throw in the towel and buy stock in these giant companies? No, I don't think that is the best way forward. There are still good deals to be had, and if you are diligent and do your research, you should be able to find them. There are super low interest rates right now, and long-term supply constraints and demographic trends indicate that the housing market is likely to show solid gains over the next decade, even if there happen to be temporary slides in prices in the interim. And most importantly, and I really, really want to stress this point, is don't forget that you have advantages too. You know your market better than any algorithm ever could. And this is coming from a guy who went to grad school to study algorithms. You care more about any individual deal than any corporation ever could. These companies are looking at massive macroeconomic trends so they can find a market in which to buy hundreds, if not thousands of units, where you, on the other hand, can hustle and find the one or two great deals in your neighborhood because you worked harder to get it. Third, you are more creative. If you're just looking at a few deals at a time, you can figure out the best way to add a bedroom, improve the value, and generate better returns. You can devote more time to making sure each individual deal produces a great return than any of these companies can. They're going to make their operations as generic and boring as possible, and they do everything in the exact same way. You can basically do the opposite. You can be different. You can be creative. You can be better than they are. You may not be better at them than buying 200 units, but you can sure be better at buying 1 unit. And lastly, you can be a better landlord. By all accounts, being a tenant in one of these companies' units can be a miserable experience. Just Google it. You, on the other hand, can be a great landlord. By finding great tenants and developing strong relationships built on mutual respect, you can reduce your vacancy, reduce wear and tear on your properties, and ensure you have excellent tenants for years to come. So by no means should we all panic. Individual home buyers and small-time landlords still have advantages to press, and I still believe that investing in real estate is the best way for normal people like you and me to achieve financial stability and independence. But the activity of these big firms is something we should all keep an eye on. I know I am going to continue to follow what's happening in the space, and I will make sure to update you all as soon as anything new comes around. That's it for me this week. For BiggerPockets, my name is Dave Meyer, and I'll see you all next week. Thanks for watching.